Hello and welcome to Gold and Silver Assets. It's Sunday, the 9th of August 2020 in New Zealand after lunch. So, for those of you who are seeing this just as it comes out, and if you live in the far western time zones, it's actually Saturday, and I'm speaking to you from the future. Today I'm going to be discussing something that I've been mulling over for quite some time, and that's the subject of retirement funds. What are the things that can go wrong with them? Now, among the general population, the subject of saving for retirement is sometimes treated like a bit of a joke, and I know I personally have been mocked at the mere mention of the word pension fund. And I think that's very sad, as being helpless and destitute in old age is nothing to joke about. Before we talk specifically about retirement funds, let's start by discussing the subject of bail-ins. We've all heard about bailouts, where the government uses taxpayers' money to prop up the banks when they run into trouble. And that's actually what occurred in the global financial crisis. Bail-in is when the bank's creditors inject funds to prop up the bank. And the creditors are the bank's shareholders, bondholders, and depositors in that order. And this has been touted to be a better solution than bailouts, as it avoids the taxpayer from footing the bill. However, surely a big chunk of the bank's creditors are actually taxpayers. And so surely bail-in is just a way of avoiding the government as the middleman. Anyway, the G20 met in Brisbane in 2014 and rubber-stamped bail-ins, which have since been written into law in many countries. And most people don't actually know about this. I certainly don't remember seeing it anywhere in the mainstream media. The exact bail-in laws do differ between countries, and so you do need to do your own research into the situation in your particular jurisdiction. But here are some of the factors that you want to consider and look for. And I've actually put a link in the description for an academic paper that actually covers some of these factors in more detail for some countries given as an example. So firstly, what is the trigger for a bail-in? And one thing I noticed is that the triggers are a bit vague, but basically they revolve around an institution being likely to fail. There is variation around what exactly can be bailed in. And again here, I did find the terminology can be a bit confusing. So, for example, you can get different types of creditors. And again, I didn't know what all of those terminologies meant for those. But the impression I get is that different creditors get treated differently. So, for example, foreign versus local creditors, or shareholders versus the depositors can be treated differently from each other. And then we come to depositor insurance. So that's been introduced, and this can range anywhere from 0 to, in the USA, it's 250,000 US dollars. And so that amount does depend on which country you're in. And this probably gives people a sense of security, but I'm not so sure. You'll see that I've put that star there that you often see, which signifies how conditions apply. And this is where reading the fine print becomes really important. So just for example, what circumstances does this actually cover? Does it only kick in when a bank actually fails? And if so, then a bail-in actually occurs before a bank has failed and the funds are used to prop the bank up and prevent failure. So does that mean that the deposits are still safe? The percentage of the haircut that the creditor gets does also vary between different countries as well as different types of creditors. And in some instances, the bailed-in capital might just be taken, whereas in other circumstances, the funds might be converted into shares in the failing bank. In New Zealand, there is no deposit insurance at all, and the term bail-in has been dolled up, and here it's called open bank resolution. So doesn't that make you feel all warm and fuzzy? Anyway, the Reserve Bank has put out this cartoon to explain exactly how it works. So if there's an unstable bank and it's just allowed to fail, then customers are totally locked out, and it could be many months before they can get access to even a portion of their funds. Under the open bank resolution, the bank would close and some of the funds are frozen, but again, we don't know exactly how much of that is frozen. The bank then can potentially reopen the next day, and then customers can then access the non-frozen portion of their account in order to pay their bills. The frozen money is then used to resolve the bank's issues. Any of the frozen funds that weren't used up can then be returned to the customer. Of course, that assumes that there is any left over. So ideally, you want to try and put your money in a bank that's not unstable or at risk of becoming unstable. But of course, how do us retailers determine that? Although there's lots of information out there, it's actually quite difficult to sift through. And anyway, aren't all the banks interconnected anyway? I think that the exposed risk is actually very difficult to quantify. Here we have a chart that looks at derivatives exposure for Australian banks, and in 2017 it was over $37 trillion, and that compares to $15 trillion in 2009. And if that gave you the heebie-jeebies, well, look at this. Each of these US banks alone has a greater derivatives exposure than all of the banks in Australia. So overall, to me, it seems that the risk of bank instability is not small, and it's certainly not zero. So back to the topic of retirement funds, which come in a range of flavours. So your workplace might provide a defined benefit or a defined contribution pension scheme, and they commonly match the employer contributions. There are also tax-favoured funds, and there are also options for self-administered funds. And usually retirement funds are locked until a specified age, so you can't access it until you reach that age. And if we look at the managed funds, they do allocate the majority of their funds in equities and bonds, but cash is also a component of that. So where I am, we're given the following options in terms of asset allocation. So you could put it all in cash, or you could have various mixtures of assets with various risk profiles as determined by the fund managers here. And as far as I know, none of these include precious metals, and there's certainly no portfolio for precious metals separately as well as within these funds. Now, one of the reasons for this is that the metals are seen to be risky, and also there probably wouldn't be the demand because, of course, most people don't really understand gold. Overall, if you think about it, the only control I have over my workplace retirement fund is how much I contribute and which of these allocations I select. Now, I can switch between these allocations once a year if I want to, and that would be free. But if I want to switch more than once a year, then that would cost an additional fee. And the other thing is that any switches do not occur instantaneously. They do take a few weeks to implement. On the plus side, contributions are matched by the employer up to a certain amount. And so if things tick along nicely, the stock market stays buoyant and the financial system remains stable, then great, I'm looking at a nice pot to retire on comfortably. But of course, life isn't that simple, and I think it's really important to look at potential weaknesses of things. What could possibly go wrong? So this brings us back to the issue of bail-ins. So if you think about it, any portion of those managed funds that is in cash or bank stocks or bank bonds might be vulnerable to bail-in, which would shrink the pot. Another possible issue is negative interest rates, which would also shrink the pot. And this is actually something that's already happening. So I heard that the Bank of Ireland is charging 0.65% on pension fund accounts. Currency devaluation is also an important factor. And if you think about it, when I come to retire in a fair number of years, that pot may have a nominal value of millions. However, that's not going to be much good to me if all it buys is a few chickens. Another thing that could happen is changes in the rules. So, for example, what if they change the age at which I can access the funds? And of course, remember that I think it's highly unlikely that they would reduce that age. So any changes would be in the upwards direction. The other thing that can happen is that tax rules can change at any point. And also things like extra fees, fees to release the funds and so on can all be added. And so all of these things together can shrink the pot. And the important thing to remember is that I don't have control of any of these things. So for me personally, do I think that my workplace pension is safe from these factors that I've discussed? And will my pot see me through retirement? And my answer is no, I don't believe it will. That's why I think it's going to be really important for me personally to have a plan B. If everything does tick along nicely and the economic system remains strong and currencies strengthen, well, that's all going to be great. Then I can consider that workplace pension pot to be a bonus. However, if those problems do occur, I want to have alternatives that allow me to maintain the standard of living that I'm used to. And so that's going to mean basically having a separate form of retirement savings that provide me with greater control. Next up, the market update. Let's start with gold priced in US dollars on the 4-hourly scale. And last week we mentioned that this triangle was in the process of forming. We also noted these little fake out, breakout candle wicks, which were affecting us. And actually, as the week progressed, we actually got more of those on the downside as well. And so this shows how this makes it very difficult to place your orders because, of course, especially this candle here ended up being a fake downwards break. And even though it closed below the bottom of that triangle trend line, price then blasted upwards. Now, we did have some really good input from a couple of people who have some knowledge of Elliott wave. I don't know a huge amount about Elliott wave other than some of the general concepts. However, they did say that this triangle represented a fourth wave, which meant that we would expect an upside breakout, and that ended up being absolutely correct. And last week I mentioned that the target price would be the height of this triangle, and we actually reached that target and then turned back downwards again. Some of the Elliott wave guys have said that the fifth wave target is actually higher than this. So Let's see if we continue on. It does depend on, you know, how big that fifth wave is. Will it be an extended wave? One way to potentially look at this would be to go back to US dollars in the daily scale, and we've got a couple of trend lines that we can draw. Now remember that we are in blue sky territory here, so we have no prior indication of where resistance is going to be. So, you know, it really is anybody's guess. So we're just going to make some attempts at where resistance could be. So first of all, there is a lot of upside. So for those of you who are new here, look at my video from 2 weeks ago to get my overview of where I think this is going in the longer term, and my targets, which are much higher than this. Of course, remember, it's not going to just go up in a straight line to get to those targets. We are going to have some corrections and pullbacks and so on. So those are the things that we're looking out for at the moment. So one way to look at this would be to look at this trend line since the breakout from the 1800 US dollar level. And so I've drawn this line here, and I've also drawn a much shallower one, which goes back to the lows from June. So really, I mean, we are still in an uptrend, and as long as that is the case, we have to assume that that's going to continue. And we'd only really be considering that a correction is occurring once we get a break of, first of all, this line really, in which case then the next target might be this second shallower trend line. And if we look at the miners, we've got a similar situation. So again, we've had this uptrend, and I've drawn the trend line there. But when you think about how gold has stormed up ahead, the miners are still seem to be holding back a little bit. They kind of seem to be stalling a bit. But as long as it remains above this trend line, we must assume it's going to keep going up unless that's broken. So let's just keep a watch on that for now. And of course, the star of the last couple of weeks has been silver. And so this is silver priced in US dollars on the monthly scale. Now, we did mention that once we get a breakout above this channel, price would move in the blink of an eye. I think those were my exact words. And that was because of this area of thin air. And we also talked about this resistance zone here. Price actually initially bounced off, and that corresponds with the bottom of these candle wicks here. But that actually didn't reject particularly strongly, and price just bounced back up, and that just shows the strength of this market. You know, this is like a juggernaut moving forwards here. So price stormed up again and actually blasted through that top of that resistance zone that I'd drawn here. And that kind of represents the bottom of these candles back here. Again, we had some rejection and prices come back down again. So the big question is, can we overcome this line over here? And if we look at silver priced in US on the daily scale, one of the things that you'll see is that I think this move is what we call a parabolic move. And the thing with parabolic moves is that they do have some significant implications. So one of them is that price has moved very, very fast, very, very quickly. And of course, such moves don't go unpunished by the market. Let's have a closer look at what parabolic moves are. So first of all, price increases exponentially. Now, one of the things that I haven't quite worked out is on the stock charts, how do you show that that price has moved exponentially? I mean, what I've been doing is just eyeballing it, but is there a way of showing that that is an exponential move, say on using the Tradingview charts? So if anyone knows, then let me know. The other big thing is that parabolic moves are very, very tough to trade on both sides. So they tend to be very, very volatile, and people can get thrown off even midway through the parabolic move. So they're tough to buy, but also they're also tough to sell on the short side as well. And part of the problem is that you just don't know how high that move is going to go, because of course it goes vertical near the end. The problem with these moves is that they don't last forever. So when they retrace big time. And so that's the punishment I was talking about. And so they can retrace anywhere between 60 to 80% of the initial move. The other thing to look out for is that the last candle in a parabolic move tends to be on high volume, and it's a reversal candle. So you'll usually see a long upper wick with these things. So let's go back to looking at that parabola on silver. Now, I'm saying it's a parabola, but again, I need to really know the definition and how I can assess this on the Tradingview chart. So if anyone knows a way, then let me know. But eyeballing this kind of does look like that to me. And I've used the curve tool on Tradingview to draw this line to try and fit as many of those lows as I can. And the reason for drawing this line is that obviously when we get a breach of that line, that would be a signal to sell, in which case we would expect price to go down here. Now, of course, that's a sell signal for those who are trading on the shorter terms. That doesn't mean that this can't go up after it's dropped again. So remember, this is just for the short term for this move. So there are a few things to consider when drawing this curve. So one of them is that when you draw this upper part of the curve, you've got to make sure that it doesn't curl back in again. This has to be something that ends up going vertical. The other thing is that I think there's a lot of subjectivity when drawing these curves. And if anyone knows a way to draw them with some kind of rule associated with them, that would be a really great help. I haven't been able to find any such thing. And if you play around with this yourself, you'll see that there's multiple kind of options for where this curve could be. So this is one option. This is another one that I've drawn here. So you can see, again, it does seem to fit, but this is much more tighter fit over here. And this would suggest that we could potentially be coming closer to the end of this move, because if we see a break of this line, that's when the move would reverse. But again, is this the correct line? Here's another one that we could draw. So maybe we're still early in this parabola. So basically, this is a very, very subjective thing. And so what I'd really love to do is find out a way of drawing a parabolic curve on Tradingview that has some objectivity to it. Another strategy that I've heard of for dealing with parabolas is by joining the previous high just before the start of the move to where you think the peak is. So let's assume that we thought that this was the peak of the parabola here. Then you basically draw a straight line joining the two. Then you clone that line and join it to the low, which I've done over here. And then you again clone the line and move it to exactly halfway between the two. And so in theory, a significant break of the middle of that channel would be suggestive that the parabolic trend has finished. But again, it's not that straightforward. So here it looked like it broke over here, but then of course it just changed its mind and turned around and moved up again. So it's not an easy one to deal with. So obviously price moved on and moved up beyond that channel, so that was incorrect. And so let's assume that, say, this might be the top of the channel. Certainly we've got a red candle with a long upper wick. Whether that's a reversal candle remains to be seen. But it was on reasonably high volume. That's not actually shown on this chart here. So again, I've drawn those channel lines, and so then we'd have to wait for basically the middle of this line to break to decide that the parabolic move has ended. But as you can see, it's very, very difficult to tell, and it's very scary to buy into this, but it's just as scary to sell into this as well, because this could just shoot up even further, up 32 and beyond. We had a really good response to last week's video regarding how much gold and silver people want to own, and we had a range of different answers. So people were actually very generous in disclosing how many ounces that they had or wanted, and some people also disclosed the percentage allocations. And looking at them, there was actually quite a range. And I don't think there's any right or wrong answer to that, only what's right for you. But we also had a few amusing comments and responses, and that gave me a good chuckle. So I think we've got a really good bunch of viewers here. So thanks to all of you. I'm also celebrating because we've now got over 5,000 subscribers to the channel. Yay! Thanks everyone, that's it from this week, and we'll see you next week. Bye!